we need to understand one brutal truth immediately. Silver is the single most mispriced, misunderstood, and structurally distorted asset class in modern financial history. We're not talking about a mild undervaluation or a simple market oversight. We're talking about a metal whose price has been artificially capped for decades, despite supply collapsing, industrial demand exploding, monetary demand rising globally, geological availability shrinking, and historical ratios being violated so severely that it borders on economic absurdity. When we look at how silver has performed over the past 50 years compared to its actual role in technology, energy, medicine, and global monetary systems, it becomes impossible to argue that the current price, in the low $20s to $30 during 2024 and 2025, reflects anything rooted in real-world fundamentals. Silver is the backbone of the modern technological world, yet it trades as if it's irrelevant. And when we lay out the numbers, it becomes clear that a massive repricing event is not just possible, it's mathematically unavoidable. To see how deep this mispricing runs, we need to zoom out thousands of years. For more than 5,000 years, silver has been central to money, trade, and global power. Ancient Mesopotamians measured wealth in shekels of silver as early as 3000 BC. The Roman Empire built its entire monetary system around the denarius, a silver coin that held purchasing power for centuries. Even in the 19th century, massive global trade flows, including the famous China-Europe tea and silk trade, were conducted in silver. The United States operated under a bimetallic standard until 1873, when the infamous Crime of 1873 demonetized silver and shifted global power toward gold-backed currencies. The point is simple. For most of human history, silver wasn't just a commodity. It was money, it was sovereignty, and it was the metallic anchor of everyday commerce. And throughout almost all of that history, silver traded much closer to gold than today. The historical gold-to-silver ratio averaged around 15 to 1 for centuries. Today, we're sitting in the 80 to 1 to 90 to 1 range, a distortion so extreme that it signals something fundamental has broken in the pricing mechanism. That ratio alone tells us silver is undervalued by a factor of 4 to 6. But the reality is even more extreme when we consider geological availability. Above-ground gold supply is estimated at around 208,000 metric tons, while silver's above-ground supply is far smaller, with industrial consumption destroying tens of thousands of tons every year. In fact, silver's above-ground availability is now arguably lower than gold's, because gold is mostly stored and rarely consumed, while silver is burned in industrial applications that make recovery uneconomical. We've reached a bizarre point in economic history where the supposedly cheaper metal is actually rarer in readily available form. If markets priced silver even remotely close to its historical ratio or its geological reality, it wouldn't be a $25 asset. It would be $150 to $300. And yet the price remains artificially compressed. Why? Because silver's true value would disrupt the entire structure of modern finance. But the undervaluation becomes even more shocking when we analyze industrial demand, which has surged so aggressively over the past 20 years that we're now facing structural deficits year after year. Silver is not simply a precious metal, it is the most critical industrial metal of the 21st century. More conductive than copper, more reflective than aluminum, and more antimicrobial than any other element, silver is woven into every layer of modern technology. Solar panels alone consumed over 140 million ounces in 2023, with projections from the Silver Institute suggesting that photovoltaic demand could exceed 200 to 250 million ounces annually by 2030. Electric vehicles use between 25 and 55 grams of silver each, depending on the model, and with global EV production expected to surpass 40 million units per year by the early 2030s, silver consumption is set to accelerate dramatically. IA data centers, an industry exploding since 2023, rely heavily on silver's unparalleled conductivity for power routing, heat dissipation, and high-efficiency switching components. The medical sector uses silver in sterilization, wound care, and antimicrobial coatings. 5G and IoT infrastructure embeds silver into sensors, antennas, and communication hardware. The more we digitize, electrify, and automate, the more silver becomes irreplaceable. And unlike copper or aluminum, silver does not have scalable substitutes for its most critical applications.
Now, here's the real issue. While industrial demand is exploding, global supply is shrinking. Silver mining peaked around 2015 and has been in structural decline ever since. Mexico, the world's largest silver producer, has experienced slowing growth due to declining ore grades. Peru and Bolivia faced political instability and reduced output. China has also seen mining reductions as environmental regulations tighten. But here's the part that most investors don't understand. 70% of all silver mined globally is a byproduct of mining other metals, primarily copper, lead, and zinc. That means miners do not respond to silver demand by increasing production. They mine silver only as a side effect of mining something else. This makes silver supply inelastic and largely uncontrollable. At the same time, COMEX vault inventories have dropped sharply from over 150 million ounces in 2020 to under 40 million by 2024. Registered silver, that is, silver actually available for delivery, is at or near all-time lows. ETF inventories have also been quietly drained. No matter where we look, physical silver is disappearing, while paper silver grows larger and more leveraged. And that brings us to the heart of the issue. The price of silver is not determined by real supply and demand. It's determined by leveraged paper markets dominated by a handful of major banks. For decades, banks have been caught manipulating silver markets through spoofing, illegal trade layering, and artificial supply expansion. The Department of Justice and the CFTC fined J.P. Morgan nearly $920 million in 2020 for precious metals manipulation that lasted from 2008 to 2016. Banks exploited the fact that the COMEX system allows the creation of 100 to 200 ounces of paper silver for every 1 ounce of physical metal. As a result, the price reflects the supply of paper contracts, not actual silver. This creates a false sense of abundance. Physical shortages can exist in the real world while the price remains artificially low. And as long as this system continues, silver will remain undervalued until the moment the paper market breaks. All of this leads to a single unavoidable conclusion. Silver is on a collision course with its own fundamentals. We cannot have shrinking supply, skyrocketing industrial demand, collapsing inventories, and record deficits indefinitely. Something has to give. And, historically, when commodities hit structural breaking points, they don't rise slowly, they reprice violently. The Hunt brothers drove silver to $50 in 1980 during a supply squeeze. It nearly hit $50 again in 2011 when investment demand surged and ETF inflows spiked. Today, the fundamentals are stronger than both of those periods combined. Silver should not be sitting at a price that reflects a world where solar panels, electric vehicles, 5G towers, satellites, IoT devices, and medical systems do not exist. But the market is still treating silver like an industrial afterthought instead of the strategic asset it has become. And if we're thinking the same way about how this massive disconnect cannot hold forever, hit that like button, because the more people who understand this mispricing, the closer we get to real price discovery. Looking forward, the 2025-2030 period may be one of the most explosive eras for silver in modern history.
The global energy transition alone is enough to trigger unprecedented demand. The International Energy Agency estimates that renewable energy installations will triple by 2030, with solar representing the largest share. Almost every solar panel produced requires silver paste. Even small efficiency improvements do not offset growing adoption. Meanwhile, governments worldwide, from the US to China to the EU, are accelerating EV production mandates. Car companies cannot reduce silver usage without compromising performance. Add in AI infrastructure where hyperscale data centers from Amazon, Google, and Microsoft are multiplying at a breakneck pace, and silver becomes the hidden fuel of the computational world. On the supply side, we face an unavoidable problem. You cannot force new discoveries into existence. Ore grades have declined for decades. New mines take 7 to 15 years to reach production. Environmental regulations slow development, and because silver is mostly a byproduct, higher prices do not automatically trigger higher output. This creates a perfect storm: rising demand, shrinking supply, and a market priced artificially low through financial engineering. Physical premiums reflect this reality. Silver eagles and maple leafs often trade at 40% to 100% above spot. When the physical market consistently trades at a premium to the futures market, it's a sign of deep structural stress.
Now let's add a geopolitical dimension. Governments and central banks are aggressively accumulating gold. In 2022 and 2023, central banks bought more gold than in any period since the 1950s. But here's the key: they cannot do this with silver. Silver's market is too small. If central banks tried to buy silver the way they buy gold, the price would go vertical. Even modest institutional interest could trigger a supply shock. And given silver's role in critical infrastructure, it's reasonable to expect strategic stockpiling in the future, especially from countries like China, India, and the US. China, for example, accumulated large silver reserves throughout the 2000s and remains one of the largest importers today. If even one major government openly begins accumulating silver, the entire market structure will be changed overnight. This brings us to the monetary debate. Gold, silver, and Bitcoin now form a new monetary trilemma. Gold is the established store of value with a market cap around $14 to $15 trillion. Bitcoin is the digital scarcity asset with a market cap exceeding $1.2 trillion during the 2024-2025 cycle. Silver is the odd one out, a hybrid metal that is both monetary and industrial, with a market cap of barely $200 billion at spot prices. But if silver were priced historically or fundamentally, its market cap would be well above $1 trillion. This makes silver the most asymmetric investment among the three. Bitcoin's scarcity is coded, gold scarcity is geological, silver scarcity is both geological and industrial, and the world is consuming it faster than we can mine it. So what does a realistic future price look like? Analysts like Goring and Rosenquag have laid out scenarios where silver reaches $100, $300, or even $500. A $100 price reflects a return to historical ratios. A $300 price reflects industrial scarcity. A $500 price reflects a combined monetary and industrial revaluation. These numbers are not hype. They are grounded in supply data, mining output, energy transition forecasts, and historical market structure. Even a mild shift in investor demand, for example, if just 2 to 3% of global wealth decided to buy physical silver, would wipe out available supply. When we combine all of this, the structural supply shortage, the record-breaking industrial demand, the broken paper market, the geopolitical trends, the historical ratios, and the monetary distortions, it becomes obvious why many analysts consider silver the most undervalued asset in human history. No other asset today is simultaneously critical to energy, technology, medicine, and money. No other asset is so mispriced relative to historical norms, and no other asset is so heavily influenced by financial engineering that ignores real physical scarcity. This is why silver isn't just undervalued, it's the most undervalued asset we've ever seen.